Joins us. Ashwini, good morning. Thank you for joining us. Uh, everyone is actually happy that the correction has kicked in. At least the bubble and the euphoria which got created, that in a sense will be contained.
Yeah, morning, Nikunj. I completely agree with you. I think there were a lot of excesses building up in the market, especially if you looked at the valuations of several government-owned companies, or you looked at the valuations of several small caps. Um, um, and if you also look at the earnings, the way the earnings have played out during the December quarter, I think the hopes were running significantly ahead of what has been delivered. So putting all of this together, I think it's good that a small correction is setting in. My personal view is that it should go a little bit deeper. That's what I think. But let's see how this plays out.
So Ashwini, I'll talk about PSUs, and
Yes.
PSUs are the leader of this bull market. But is the leadership now coming at the cost of risky valuations?
Because I would like to think so. See, principally what happens is that public sector companies, they have certain inherent inbuilt checks and balances, which cause their decision making to be slower than it would be for the private sector. That is how the construct of a public enterprise is. So you have the CBC, you have the CBI, you have the tendering process for any award that you want to give, any contract that you want to give out, any vendor you want to hire. All of this makes decision making significantly slower in a PSU than it would be for a private sector. So to expect that PSUs will operate with the same efficiency as the private sector is a little bit of a stretch, in my personal opinion. Second is, if you just sift through how some of these stocks have done relative to the others, and if you were to look at some of the number four, number five PSU banks versus the market leader, the price action suggests to me that it is highly speculative as compared to something driven totally by fundamentals. And that's something that I would say is true even for a whole host of smaller PSUs where the free float is fairly small. So I think there is a significant amount of froth in the public sector enterprise system. There might be some leaders which are still reasonably priced, but I think by and large it is my opinion that the public sector enterprise as a whole is quite expensive as a stock universe.
Ashwini, not an apple to apple comparison, morning firstly, but wanted to understand, what sort of an aftertaste does the market get after incidents like, say, last year, what happened with the Adani Group, with the Hindenburg case, and now with Paytm? I mean, after these serious, now that they're facing a serious risk of customer exodus after, RBI putting curbs on their payments bank.
Morning, Aisha. Aisha, accidents are a part of the marketplace. So if you zoom out and think about the last 20 years, there have been so many situations. You had the MS Shoes scandal, you had various other companies that went bankrupt from time to time, and I think this is part and parcel of investing. Equities is a risky asset class. So, does a Paytm incident, for example, completely rattle investors? It's obviously painful for those there who own it, but by and large, if you're running a diversified portfolio as an individual or as a fund manager, whichever may be the case, the damage to the aggregate portfolio should be fairly limited. I think booms and busts, they all produce extraordinary gains and extraordinary losses. And I think this is part and parcel of it. I don't think it damages the underlying story for India or the global sentiment on India in any way. I think that's how I look at it. So it's not such a big deal in my personal opinion.
Ashwini, hi, morning. Given that the expectations are riding high, that the overall Capex theme is really going to boom owing to the fact that it's also election year, what's your sense when it comes to this entire pocket?
I have been waiting for the private sector capex to kick in, and that hasn't really happened in a big way. And if you look at the interim budget numbers, while the government has continued to allocate money towards capex in favor of, in comparison with consumption-led expenditure, I think the impulse factor is lower. By impulse, what I mean is year-on-year change in terms of how much money is going into government capex. Also, if you look at the liquidity situation, it is tight because the government hasn't spent a lot of the money over last year. So while there is capex that's going on, I think the pace is slower than what was envisaged. And I think going ahead, also the government would like the private sector to step in, and that is, I think, lower than expected at this point in time. Is how I think about it. In the meanwhile, if you look at it, the stocks have moved up. Everything's rallied. Valuations in certain cases are completely completely crazy. I mean, 60, 70, 80 times or 30, 40 times for construction companies. I mean, I don't think that these valuations are sustainable. We have to remember that capex-led plays are inherently cyclical. There are deep cycles, and you have 3-4 years of boom followed by 3-4 years of losses. So you have to pay a lower P multiple for peak earnings, and you have to buy them when the chips are down. So I think one has to be careful here as well.
Would you say that now it's time to, let's say, raise 10-15% cash, sit on cash levels which are disproportionately higher than what you've run in a long time? Why are you smiling on that question?
I'm smiling on that question because, Nikunj, I've been sitting on cash of somewhere of that nature. Last 3 months has been very painful. But I'm increasing my cash position. I just run my own family office, but I am increasing my cash position as we speak, and I will continue to do so. I think markets are expensive. I expect a reasonable amount of consolidation, maybe a deeper correction. I don't know which one it will be, time correction or price correction, but one of them has to happen. I think if I look out on 2024 as a year, I'd be very happy with market going nowhere. Through the year, there will be, of course, stock opportunities on a bottom-up basis, which I hope I will find. But by and large, is this a good time to be holding some cash? Yes, absolutely. Is one should take the profits where valuations appear to be disproportionately high or the story seems to be stretched. I think too much of a good thing is never a good thing.
Too much of good thing. I look at the stock price of a Paytm. I look at the stock price of metals. I look at IT. I mean, there is bad news. There are bargains available.
Yes, there are bargains available for sure. I think if you look at the upstream chemical sector, after the peak of earnings in 2021, last 1.5 years, you've seen a significant amount of decline in revenue and decline in margins led by inventory liquidation from the customers globally, and you've seen slowdown of demand as well. So I think, yes, you're right. There are bargains available within the financial sector. Also, there are bargains available. There are other places where one can look for bargains. So yes. I mean, on a bottom-up basis, there will always be opportunities. That is the nature of the market. But if I think about a portfolio allocation, and let's say I want to hold my equity exposure, just taking a number out of the hat, not a reflection of how I think about it personally. But let's say for an investor, 60% is the percentage allocation towards equity that he wants. At this point in time, my advice would be go down to 50 or 48 or something like that and hold the cash. Nothing wrong with that. If the market goes up, you still have half your money in stocks, and you benefit from that. But the likelihood that you will get a better entry point is quite high if you wish to take cash calls. There is another school of thought which says that cash calls don't make sense, and one should always be fully invested, which is fine. Even then, a mere portfolio reallocation and right-sizing your equity exposure will force you to sell if you've been fully invested from that perspective. So I think yes, that's the right thing to do.
When will you use that 15% cash? On a 15% decline or more, or even furthermore? 15 pe 15?
Nikunj, it's very difficult to say. So one will have to watch as things evolve. See, let's take an example, right? in September, the bond yields peaked out in the US, and there was a huge expectation that interest rate cuts will come through with a vengeance in 2024. As we stand today in middle of February, our expectation now is that rate cuts have been pushed out by another 2 or 3 months. So, the market evolves, the fundamentals evolves, story evolves. So we'll see. I feel things are expensive today, so I'm sitting on cash. I might change my mind, based on how the data evolves. So I don't think anything is cast in stone, and it won't be profitable for anyone to believe that the market will go down 15%, and that's when you put everything in. I may find bottom-up opportunities which are interesting, which I'll force my hand and I use up this cash. I think it's an evolution, and one has to watch things on a daily basis and remain flexible.
Ashwini, that's exactly what I was going to ask. Forget the cash. What's the shopping list looking like? You did mention bottom-up stories, but is it going to be more of the same, whatever has worked in the year gone by, or newer themes that you're looking at?
So I'm actually quite excited by the whole chemical space where the earnings cycle seems to have bottomed out. I continue to believe in pharmaceuticals, where I think the pricing environment and the demand environment are reasonably solid. Um, I think IT services might be a place to hide. I don't own it personally, but I think from a risk return perspective, in a benchmark portfolio in IT services, holdings might actually do reasonably okay. I don't think there's a lot of absolute gain to be made there, but on a relative basis, they might hold up. So there are pockets to own, even on a bottom-up basis, across export-oriented units, domestic demand-oriented consumer staples names. There are bottom-up opportunities which I find quite exciting.
Okay, Ashwini, final question. If one looks at the big theme in India, it is consumer.
Yes.
The street is divided on this K-shaped recovery or this V-shaped recovery. There are data points which say that the recovery is structured. There are data points which say the recovery is very urban and luxury focused. Do you see that changing as the economy now normalizes?
I hope so, Nikun. I really hope so. I think it's the narrative that only the rich are doing well is not very good for a country like India, where 95, 97% of the people are not being able to participate in the consumer euphoria. So I think it is very important that the down leg of the K, if I were to say that, would also start to see some boost in income. And I think the RBI is on the right track there by saying that, look, we have to get the inflation down. So inflation is one component which eats into household savings, into domestic savings, especially for the middle and the lower layers of the pyramid. I also think that the expenditure on the government capex that's been going on will finally get released, hopefully in the next 6 weeks to the end of the financial year, and will ease the liquidity, and that will hopefully help some consumption. But my hope is that the consumption will become more even than uneven. Over the last 1.5 years, it's all been about premium and luxury, and I don't think that's the right narrative for a country like India. So I'm really hoping that it will be more even going ahead. Certainly, if I look at some of the opportunities in the market, I had mentioned consumer staples earlier. I think on a relative basis, select stocks there are starting to look attractive, and I would venture there. I do have some positions there already, where raw material prices are benign. The margin outlook is reasonably constructive, and demand factor is missing, and I hope that will kick in.
Interesting. Ashwini, always good to have you on the show and chat with you.
Thank
Thanks
you.
for taking the time out.